David, private market assets are no longer just for college endowments and institutions. It seems though everyone is jumping into those private markets. Why is this happening, especially when you see the index is doing so well?
First, Greg, thanks for having me. Appreciate you having me on the show. I think investors are realizing that there's a larger investment opportunity available to them that's inclusive of private assets. A couple things I would point out there. When you look at public equity assets, I'd point out that over the past 20 years, we've actually seen a decline in the number of publicly listed companies by about 50%. And at the same time, we've actually seen equity concentration on the rise. I think last year's a classic case of that, with the Mag 7 stocks driving 55% of the S&P 500's return. That puts unintended risk in investor portfolios. Conversely, on the private side, what you see is growing investment opportunities. You look today at the United States, 80+% of companies that are generating more than 100 million in revenues are actually private companies. The second thing I would just quickly point out is that I think there's been a lot of innovation as well in the structuring and the technology of private investments. And that's incredibly important, particularly when you talk about trying to scale distribution into the retail wealth space.
And which type of private assets have you seen the most demand for in your practice? Is it private credit? Is it crypto? Is it real estate? What do your clients want from you?
Yeah, so in aggregate, private assets have been growing rapidly. I think it's about 14% annualized growth over the past 10 years. When we look at advisor allocations, those are also amplifying. Today, you got about 4 to 8% average allocations from advisors. That's double what it was 5 years ago. What we're seeing is 3 primary categories of private assets: private equity, private credit, and private real assets. If you look at private credit, what you see is a 10x growth in the assets under management over the past 15 years. And a lot of that's been driven by the retrenchment of banks stepping back from specific lending segments, both to consumers and business. We think this is going to continue to grow, particularly as private credit matures, moves beyond just being a direct lending facility to actually also moving into asset-backed. On the equity side, I'd also point to the introduction and growth of secondaries. Those have a very seasoned return pattern, something that financial advisors and investors can apply to their holistic portfolios.
And how do you allocate private assets along with public ones? Because there may be some overlap.
That's a really, really, really great question. First of all, I think, not to state the obvious, private assets are not homogeneous, just like public assets are not homogeneous. Private equity tends to have more of a return enhancement angle to it. Private credit, more of an income enhancer. Real assets tend to be more diversifiers. When we think about bringing together private assets and public assets, we think it's always important to start with the investor's goals and objectives. And then there's some additional things that we consider. The first thing that we additionally consider is, does the investor have the capacity and the utility to hold an illiquid asset in their portfolio? Additionally, asset allocation is really a math exercise. So when we look at the data, we do think there are some additional modifications to the data when we're looking at things like risk, return, and correlations. But ultimately, we do think as long as you have a sound process, it's consistent with the investor's goals and objectives, private and public assets actually work very well together.
And then finally, over at AssetMark, how do you make sure you're putting the right client into the right alternative or private market asset?
Yeah, that's a great question. First of all, just stepping back, institutional investors have been allocating to private assets for 30 plus years. So again, we're really talking about how do we help financial advisors help retail wealth clients? A couple things. One of them I just mentioned, which is a focus on, does that investor have the capacity and the utility to handle some illiquidity in their portfolio? I think a second and really important thing is education. It's really important to have a good understanding of what you're investing in. Private investments are more complicated, both in terms of the assets and in terms of the structuring. So that's also a really, really important factor. The third factor is there are regulatory considerations as well. There are investor qualification rules. So most investors have to, at a minimum, be accredited investors. Some of these solutions will also require that the investors be qualified purchasers. So those are three things to look for.
All right, well, thanks for coming on and talking about them.
All right, thank you.